Hey everyone, welcome to Wealth Redefined. Let's try that. Hey everyone, welcome to Wealth Redefined. I had the mic way over there and wasn't even talking into it. That's why I paused for a minute there. So welcome to the Facebook Live, YouTube Live green room before the recording. Glad to be with you. We're going to keep it short today, short and simple. We're going to talk market returns during a presidential election because today is election day. So let's get started. Hey everyone, welcome to Wealth Redefined. I'm your host, Michael Reynolds, independent financial advisor and owner of Elevation Financial, located on the web at elevationfinancial.com. Thanks for joining me today. We're going to keep it short and simple. Today is a short and simple episode. We're going to talk briefly about markets during the presidential election because this is election day or post-election day, depending on when you are listening to this. I'm recording this on election day. It's going to go out Wednesday morning after election day. So who knows what the landscape's going to be, what the decision or not decision is going to be. But we're in kind of a heightened, turbulent time right now, obviously. A lot of emotions running high. And I want to talk about those emotions today, specifically as it relates to the market. So what I want to point out and what I want to kind of encapsulate in today's episode is that there's going to be a lot of predicting, a lot of kind of emotional hand-wringing and opinions being thrown around in the days surrounding the election. Depending on what happens, it may be decided quickly, it may not be, but there's going to be a lot of opinions, a lot of predictions, a lot of different kind of voices talking around this time about things related to the election. So it's natural for people to be concerned and to be a little bit stressed out about the market and about their investments. I'm not going to get too much in detail about stuff non-related to investments. There's a lot of opinions to be had around the election in general, but today I really just want to kind of focus on relating with money around an election, and specifically relating to your investments, because we invest in the market. We invest in mutual funds, stocks, bonds, things that are not guaranteed to give us a return, but historically have been expected to give a return. And we know there's some risk associated with that. We know that investing in the market has some risk. That's kind of how it goes. Uncertainty and certain events like elections can lead to additional volatility, which volatility is a fancy word for just kind of the market going up and down and changes in the market. So for context, I want you to think about the markets as kind of a powerful information processing machine. So the combined impact of these millions of investors that are placing billions of dollars worth of trades every day results in market prices that incorporate the expectations of those investors. It kind of incorporates this huge, broad spectrum of expectations. And that really makes the market difficult to outguess. It really makes it almost impossible to consistently outguess what the market's going to do and to predict what the market's going to do. So that being said, that right off the bat should kind of relieve you a little bit of worrying too much about it, because there's not much you can do about it. The market's going to do what it's going to do. It's going to go up, it's going to go down. Historically, it's trended up. So if we look at data for the stock market going back to 1926, and this data is out there everywhere. I'm referencing data from Dimensional Fund Advisors, but you can Google this and find all this data I'm talking about by just using Google. But if you go back to the stock market, back to as far back as 1926, it shows that the returns in months when presidential elections took place have not really been that different from returns any other month. They've been very similar. So this idea that a presidential election means turmoil and turbulence in the markets is not really backed up by data. Now, yeah, there probably will be some short-term bounces, some short-term ups and downs, some short-term changes in the market, which might stress people out. But in general, that month during the election, the returns are really not that different from any other month. Election months in general show there's no clear pattern based on which party had won the presidency. So there are a lot of people out there I know that are thinking, okay, if my candidate doesn't win, I'm going to get scared. I'm going to think, oh, that's bad for the economy, bad for the markets, because I have an emotional connection or even an objective connection to this candidate that I voted for. If that person doesn't win, that means bad things for the economy. We irrationally sometimes attach way too much significance to the outcome. And honestly, there's really no clear pattern based on which party won the presidency and all that time the data has been collected. So it's really natural for people to look for a connection between who wins the White House and which way stocks are going to go. But keep in mind that investors are investing in companies. They're not investing in a political party. The companies focus on serving their customers and helping their businesses grow. And that's going to happen regardless of who's in the White House. The ingenuity and the spirit of American business is strong no matter what's happening in the White House. Now, obviously, there are some things that can be affected. There's taxes, there's regulations, all those things can play a part. But in general, the strength of American business it's very resilient. And so the political party is, I don't want to say irrelevant, but I would say virtually irrelevant to the behavior of the stock market. Again, there are some caveats. There are some ways it can affect the stock market, but in general, it's not as correlated or not as directly tied as people might think. And in general, if you look even longer term, the disciplined investing approach has been rewarded no matter who is in the White House. In fact, there's a lot of data there's various different data sources. You can Google this. In fact, if you want to Google, search for stock market returns by president. That will bring you a whole bunch of articles. One is by Forbes, which is a pretty good one, well put together and easy to understand. And it illustrates that a couple things. One is this particular source that I'm referencing in Forbes says that the stock market has done better historically under Democratic presidents. But it's also quick to point out that that's not necessarily, you shouldn't take that as a direct cause and effect. It's just happened to be the way things have gone. Other sources say there's really no clear evidence that there's a big difference between one president to another. So if you look at the graphs that you'll find when you search for these things, you'll see that when the graph is illustrated, you look at the stock market and you look at the returns going up and up and up. And in every single president during that term, you see a lot of consistency. So this idea that, if your candidate doesn't win, it's bad for the economy or whatever, particular stress point is getting to you, that's not really backed by data. The disciplined long-term investing approach, that's what pays off. And in fact, if you react to the market based on fear and based on emotion, that can often lead to really costly mistakes. You can really kind of get yourself in a bind. I've seen a lot of people that, during the last presidential election, they, when Trump won the presidency, they, stocks, took a dip. They pulled out of the market. They locked in losses. And then the market went back up. They tried to get back in, but at that point, they'd already locked in losses, and they'd been better off just staying in the market. So keep that in mind. I just want to keep this short and simple and really caution everyone listening to not react financially based on fear or emotion, and instead to continue to follow your plan, work your plan, stay the course, and don't let the hype and the emotion around the presidential election change the course of your financial plan necessarily, unless you have a good reason to. But don't let the fear and the anxiety and the emotion change that plan. So that's what I wanted to remind you about today. Keep it short, keep it simple. If you have questions, reach out to me at podcast@elevationfinancial.com. I'd love to hear from you. And of course, keep in touch. Send me a note. You can also reach out via my website and book a complimentary money session. I'd be happy to answer any further questions you have at elevationfinancial.com. So again, be safe, enjoy the week, and have a great day. We'll see you next time. All right, thanks everyone. Green room portion. Didn't see any comments or questions coming in today, so I'm going to go ahead and wrap it up there. So as always, reach out to me at elevationfinancial.com and have a great day. Thanks.